Hey guys, so today I want to start introducing some trade ideas, and the first name I'm going to introduce is a gold name. Okay, so I recently interviewed Rick Rule on our live stream, and Rick said something I found very profound.
The most important thing, though, that I think your listeners need to contend themselves with is market share. Right now in the U.S. market, precious metals and precious metals investments comprise about 0.5% of total savings and investment assets in the U.S. market. The 3-decade mean is between 1.5% and 2%.
And then Rick went on to say,
early in terms of moves that can be parabolic is not really too early.
Well, in the former quote, he was referencing the precious metals market, and in the latter, he was referencing the uranium market. Both facts hold true. And as it currently stands, the gold market, by all accounts, is the last place that retail investors want to be. Despite near record high gold prices, retail has found itself chasing other sectors rather than taking the too early is not too early approach. Okay, so we've established that it's too early for gold, possibly too early, but why do we think it's going to start moving in the near future? Firstly, it's simple. Thanks to COVID, we saw unprecedented monetary easing, with US M2 money supply expanding nearly 40% over 18 months and stimmy checks being handed over to people in a helicopter drop that delivered freshly printed money into the hands of Main Street. Secondly, as the economy comes back online and out of COVID, we are looking at an energy crisis around the world. Natural gas prices are up nearly 400% in Europe. India is running out of coal. China has shut down Bitcoin mining, and we've seen their major coal producing province have massive floods. Oil is over $80. I can go on. Thirdly, these energy crises will lead to various supply chain breakdowns. Whether we're talking about fertilizer production, which heavily relies on natural gas prices, which could lead to food shortages, or if we're talking about various suppliers of electronics being forced to shut down thanks to extreme energy costs, we are seeing the energy crisis lead to a breakdown in supply chain. The point is this: inflation is here, and the Fed has finally come to terms with how it isn't transitory. Okay, so I like torque when I play gold, but I also like companies with real balance sheets and cheap comparable valuations. Which brings me to Inca One, a Peruvian gold producer with 2 fully permitted mineral processing facilities. Why do I like Inca? It's simple. First, the company is trading at a valuation lower than its annual top-line revenue, with a recent quarter of around 8.4 million US dollars and a current market cap of around 13 million Canadian. At the time I film this, they trade at a trailing price to sales ratio of less than 0.5 times. Secondly, Inca One has a direct comparable in the Peruvian market that trades at a much higher multiple than they do. Thirdly, while focused on the gold space, their operation is rather agnostic to the price of gold, so this recent weakness in the spot market doesn't really impact them. But given the company's operational structure, they have the ability to scale their model to much larger numbers, which I'm going to get into shortly. So Inca One has 2 metal processing plants in Peru. They work with both artisanal miners and small gold mining operations whom they purchase raw ore from, extract the metal, and form into bars and coins to be sold into the larger precious metals market. Breaking it down into simpler terms, they support small operators by providing a service that they otherwise would not have access to, which gives the little guy access to the larger global gold markets. Heck, you can even go on their website right now and order a gold coin, but demand for the physical metal is so hot right now that they will only allow you to actually buy it if you prove that you're a shareholder. Okay, so getting back to the operations, the challenge that the company has had is working capital to purchase raw ore, and this is where management gets creative. They introduce a debt structure where they borrow fiat money in exchange for an agreement to pay back the loan in gold bars. It started in March. Inca announced their first $2.5 million facility, and then in August announced a new facility for $9 million, which will be paid back in monthly installments of 261.3 ounces of gold per month. Okay, so let's look at this from a mathematical perspective. At an average grade of around 14 grams per ton at 200 tons per day of production, it works out to roughly 3,000 ounces per month of gold production. In dollar terms, that's roughly $5.3 million in monthly revenue. And if the firm is paying, say, 70% of spot price for the raw ore, that's roughly 3.7 million US dollars in variable costs, plus any fixed costs the company has, such as facility overhead, taxes, management wages, etc. But I digress. In simple terms, if production were to double from here, well, those variable costs may increase at the same rate as top line revenue, with fixed costs staying effectively the same. Suddenly, bam, you have your increased bottom line margins. And why do we trust management to scale this puppy? Well, Well, just this year alone, the company has grown from around 2,300 tons of ore processing in March to over 6,800 tons in August. And again, despite these improving economics, the improvements evidently have not been reflected in the company's share price, where the company is trading below top-line revenue. Well below. The company has indicated that it intends to open a third and fourth processing plant, each with an initial processing capacity of 350 tons per day, before expanding the operating lines at each facility to achieve a target of 4,000 tons per day processing capacity by 2028, which would significantly change the revenue profile of the company as a whole. Okay, so here's the deal. In summary, we have a company showing massive top-line revenue growth with creative debt structures allowing them to scale rapidly, and a balance sheet where the current market cap is less than the assets on the balance sheet and certainly less than the revenue on the income statement. But most importantly, we have a unique structure that I think retail investors are really going to dig when the gold market starts to finally catch its tailwinds, and trust me, I think it's coming. Guys, thanks for tuning into this trade idea, and please smash that like button, subscribe, and ring that notification bell so we keep making more of these videos. All right, thank you everybody.